Welcome to the Deep Dives, where we take the most complex stories in the market and, well, we strip them down into the essential knowledge you need to be well-informed. Today, we are focusing on a company that is, it's operating at the absolute epicenter of modern infrastructure and, let's be honest, hype. IREN Limited, trading under the ticker IREN.
And this deep dive is, I think, really necessary because IREN is genuinely positioned at this collision point of two diametrically opposed technological forces.
Right.
On one side, you've got the highly cyclical, often maligned world of crypto mining, and on the other, the explosive, demand-infinite future of artificial intelligence.
And that collision point, that's what creates our central conflict here. What do you do with a company that built its entire foundation as a green Bitcoin miner, only to suddenly announce a colossal, game-changing $9.7 billion AI cloud contract with Microsoft?
Yeah.
If that news were released in a vacuum, you'd expect the stock to just to go ballistic, right?
That's the logical assumption. For a contract of that magnitude, it fundamentally validates their entire strategic pivot. But, and this is the key, here's the reality we have to deal with.
Oh, yeah.
This stock simultaneously crashed 35% from its recent high just days after that major contract announcement.
Wow.
And that immense volatility, it signals one thing very, very clearly. The market is not just looking at the size of the opportunity. It is intensely focused on the execution risk and the geopolitical risk that sits just beneath that giant contract number.
So we have an infrastructure company with a seemingly world-changing deal, but the stock price is acting like the whole foundation is unstable.
Exactly.
Okay, so our mission today is a complete deep dive analysis. We're applying a rigorous value investing framework. You could call it a Buffett-style analysis, but augmented with all the necessary modern data to figure out why the market is so, well, schizophrenic.
And we're looking at IREN as of November 14th, 2025, when the share price was $46.37.
And we're going to tell you the conclusion right up front because it really informs everything that follows.
Yeah, I think we have to. What our discounted cash flow model suggests is that the market is currently pricing IREN rationally. The current stock price of $46.37 is almost perfectly balanced.
Balanced how?
It is sitting on a knife's edge between the promise of spectacular, durable, high-margin reward and the terrifying reality of immense execution challenges and imminent geopolitical risk.
And we're going to walk you through that entire calculation, showing you how a traditional value framework struggles but ultimately succeeds in quantifying a highly futuristic growth story.
Well, for companies like this, the conversation really revolves around two things. It's the moat and it's management's ability to execute flawlessly.
It's the very definition of a story stock.
It absolutely is. You, the investor, are not investing in the modest earnings they generated last year. You are placing a massive bet that management can successfully transition this organization from being a volatile Bitcoin miner into one of the critical kingmakers, providing the foundational infrastructure for the global AI revolution.
And that requires a ton of capital.
Massive capital, impeccable timing, and a level of logistical sophistication they haven't yet proven. So let's see if their infrastructure and financials can actually support that massive leap.
Let's dive in and start unpacking the nuts and bolts. Part 1, Chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
The first, and I'd say the most crucial step in understanding IREN is internalizing that they are no longer the business they were even 18 months ago. Their fundamental identity has just completely shifted.
Yeah, from a single product miner to a dual engine infrastructure company.
Exactly.
So we have to start with that concept of their dual engine infrastructure. For the early years of the company, the legacy business was, pure play Bitcoin mining. They operate these massive data centers filled with specialized hardware called ASICs, generating block rewards and transaction fees.
Right. And that legacy business, which runs off their vast power capacity, is still the company's current operational engine. As of May 2025, that Bitcoin mining stream generated the vast majority of revenue. We're talking approximately $64.7 million in revenue just for that single month.
So it's still what pays the bills today.
It pays the bills. But the hypergrowth, the staggering valuation, and the whole reason we're doing this deep dive,
Right.
It all rests entirely on the new engine, AI cloud services. This is where they take that exact same physical infrastructure, the land, the substations, the data center shells, and repurpose it to host these massive fleets of high-performance NVIDIA GPUs.
And those are then rented out to run large AI models, which is the core service.
And this is where the disparity that makes the stock so risky becomes, crystal clear. That new AI cloud business, the one that holds the key to the future,
Yeah,
it only brought in about $2.2 million in revenue in May 2025.
2.2 million.
Just 2.2, you do the math. That's only about 3% of the legacy Bitcoin revenue.
Wow, that's a staggering gap. So you, the investor, you have a company where 97% of its current revenue stream is in this volatile commodity-driven sector, yet 100% of the $46.37 stack stock valuation is based on the idea that the tiny 3% segment will rapidly become the dominant engine.
The market is pricing in a total transformation, nothing less.
To manage that, they're focused on building out this high-performance computing, or HPC capacity. So they need the best, most in-demand GPUs, like the NVIDIA H100s, the upcoming B200s.
And the liquid-cooled GB300s. And on the Bitcoin side, they've also reached a pretty impressive 50 EH's self-mining capacity.
Okay, since we mentioned it, let's quickly define EHs for the listener. EHS stands for exahash per second. A hash is a computational problem that Bitcoin mining hardware solves. An exahash is 1 quintillion hashes.
It's a huge number.
It's a massive number. So 50 EHs means they're attempting 50 quintillion calculations every second, which is, that's a massive scale of processing power. It affirms their position as a top-tier miner, even if that business is secondary now.
Exactly. But IREN's ultimate value proposition is not their mining capacity or even their GPU count. It's the scale and integration of their foundational assets. They operate 6 geographically diverse data center sites totaling 2,409 acres of owned land.
And their strategy has always been vertical integration. They don't lease, they own the land, they engineer the substations, they build the data centers themselves.
Which gives them immense control over costs and, crucially, speed of deployment.
And this vertical integration is the whole reason they possess a true competitive advantage, what value investors would call a moat. Low-cost green power.
Yes. They have secured an immense 2,910 millidebris of grid-connected power.
And that power acquisition, that is the single most important detail in this entire analysis. They secured this power at an average cost of approximately, 0.033 cents per kilowatt?
Yeah. 3.3 cents.
That is ridiculously low. Especially in North America, where average industrial power costs can easily hover around 7 to 12 cents per kilowatt.
It's a massive, durable cost advantage. It's very difficult for new entrants to replicate quickly.
And it's not just cheap power. It is entirely 100% renewable. It comes from secured contracts for hydropower, wind, solar.
And that's why they are not just surviving, they are thriving in this AI shift.
Let's explain why that 100% renewable factor is so critical to the AI pivot. AI requires enormous planetary scale energy demand.
A huge carbon problem.
Huge carbon problem for the massive hyperscalers like Microsoft. So IREN provides a ready-made solution. They offer green compute.
So by partnering with IREN, hyperscalers can grow their AI capacity exponentially without damaging their own ambitious ESG and decarbonization goals. It makes IREN a highly preferred partner.
It completely differentiates them from competitors who are just using fossil fuel-generated power.
And this is the sales pitch that Microsoft just validated. On November 3, 2025, they announced that cornerstone deal, a $9.7 billion 5-year AI cloud contract with Microsoft.
Now, here's where we need to apply some critical thought, as our listeners often ask us to do. How can a company with just $500 million in annual revenue handle a contract that's nearly 20 times its current size? Doesn't that risk overextending management, infrastructure, everything?
Well, that is the core execution risk. The $9.7 billion is expected to bring in $1.94 billion in annual recurring revenue. But you have to ask, what is the nature of this revenue? The sources indicate that this contract is structured as dedicated capacity provision. It's not pay-as-you-go. It's a commitment by Microsoft for IREN to build out and operate a specific, massive fleet of GPUs for their exclusive use over 5 years.
Okay, so the revenue is contingent on IREN delivering the infrastructure. That mitigates some of the demand risk, but massively increases the construction and, supply chain risk.
For sure.
Does the contract guarantee specific GPU types like the H100s, which are basically gold dust right now?
The public filing doesn't detail every single GPU model, but the success of the whole thing hinges on their ability to source them. And that's why securing the NVIDIA preferred partner status is almost as important as the Microsoft contract itself.
Right. You can't execute a $9.7 billion deal if you can't get the hardware.
Exactly. This status gives them a crucial allocation advantage for those scarce H100s, B200s, and the necessary liquid-cooled GB300s.
So that's the key leverage point. They've got the power infrastructure, they've got the client validation, now they just need the chips. And their
Yeah.
scaling targets are jaw-dropping.
They are. They're currently operating about 23,000 GPUs, but they're targeting a massive fleet of 140,000 GPUs by the end of 2026.
That transformation timeline is hyper-aggressive.
It's what justifies the PE ratio, though, because the market potential is just immense. The Gen AI market is projected to reach, $1.3 trillion globally.
And the infrastructure spending, the picks and shovels that IREN provides, is set to hit $758 billion by 2029. They are in the right place at the right time.
You'd think so.
But let's go back to the moat. We said the power is the barrier to entry.
Correct.
Why isn't it capital or GPUs?
The sources confirm this, and it's a reality on the ground. The main bottleneck right now is not capital, which is abundant, or even the chips, though they are scarce. The biggest barrier is secured, grid-connected power.
Why is that?
Due to aging infrastructure and massive demand spikes, new data centers are often being built and then just sitting idle. They can't get enough grid-connected electricity. So IREN's existing, secured 2,910 milligalio gives it a multi-year head start that you simply cannot buy overnight. They solved the hardest infrastructure problem first. That is their core asset.
Chapter 2, Management Evaluation. Okay, so an infrastructure company is only as good as the people who plan the substations and secure the financing. Let's look at the leadership of IREN. We've got co-CEOs Daniel and Will Roberts.
And this is the crucial context for believing in the pivot. These are not crypto bros who accidentally stumbled into power assets. They're highly sophisticated infrastructure finance professionals.
Right. Daniel Roberts co-founded Palisade Investment Partners, an infrastructure asset manager. And Will Roberts, he served as a vice president at the powerful infrastructure conglomerate Macquarie Group.
Their whole background is in managing massive, stable, long-life assets. Think wind farms, toll roads, airports assets where cash flow is king and risk is minimized.
So when they entered the Bitcoin space, they saw it purely as an infrastructure play.
Precisely. They viewed Bitcoin miners as a perfect, highly flexible, interruptible buyer of last resort for cheap, stranded, renewable energy that the grid couldn't always absorb.
So when the opportunity arose to pivot that same physical asset, their low-cost power infrastructure, to the higher margin, more stable demands of AI, it wasn't a desperate shift.
No, not at all. It was a logical, planned, second use of their core competence and their core asset base.
Okay, so how does that pedigree translate into execution? We talked about that 3.3 cent per kilowatt hour power cost. How did their infrastructure background enable them to secure power so cheaply and expedite the substation construction, which is usually a multi-year bureaucratic nightmare?
Well, that's the application of their infrastructure mindset. Their prior experience in developing large-scale renewable projects gave them the political acumen, the regulatory expertise, and the long-term relationships needed with utilities and regional grid operators.
They already knew who to call.
They knew who to call, and they understood the nuances of power contracts, site acquisition, and transformer engineering far better than a typical software or crypto startup. They weren't just buying power, they were integrating with the grid, which speeds up development and drastically lowers those input costs.
That background gives their ambitious expansion a lot of credibility. But as the business complexity exploded, they needed help managing the financing.
Oh, for sure.
And that's why the hiring of Anthony Lewis as the new chief financial officer in September 2025 was such a huge signal to the market.
It was a strategic necessity. Lewis is a 22-year veteran and a former co-treasurer at Macquarie Group, specifically tasked with global funding and capital management. You bring in that level of expertise because the complexity of their balance sheet is now enormous.
I mean, we're talking about managing the issuance of a $1.0 billion zero-coupon convertible note, the complexity of a $400 million GPU financing arrangement, and now the flawless management of prepayments, construction drawdowns, and the intricate revenue recognition for that massive $9.7 billion five-year Microsoft contract.
Correct. The revenue recognition alone for a multi-year, multi-billion-dollar build-out contract is highly complex. It involves milestones, depreciation, service components. Lewis's hire signal to the market. We know this is too complicated for our existing team, and we are paying top dollar for the best capital markets expertise to manage this hyper-growth phase.
Okay, so let's shift to their capital allocation strategy. It is aggressive growth, 100%. They are focusing entirely on organic growth building out that 140,000 GPU fleet. It's truly a bet the farm strategy.
That's absolutely right. They are in a massive capital expenditure cycle. This is why you see no shareholder returns. Management has explicitly stated they are deferring the consideration of potential investor distributions to accelerate their strategic investments. Every single dollar is being poured back into land, substations, and GPUs.
Which naturally leads us to the ROIC red flag.
Yeah.
Their return on invested capital is currently negative, hovering between negative 0.01% and negative 7.8%.
Yeah.
A classic value investor looks at a negative number and immediately runs.
And they should, based purely on that metric alone. But we need to understand why it's negative. The negative ROIC is the temporary price of the pivot.
Okay.
Think of it like a massive factory analogy. IREN is currently spending billions on construction and hardware, which explodes the IREN invested capital. They're incurring debt and costs, but those assets haven't started producing their 98% gross margin widget yet, the IREN return.
Right. So until the 140,000 GPUs are fully installed, powered, and delivering revenue, the ROIC will likely remain low or negative, making them look fundamentally unhealthy by those traditional metrics.
Exactly. The entire bull thesis is predicated on the idea that in 2026 and 2027, that negative number will not just flip to positive, but flip to spectacularly high positive, reflecting the 98% gross margins of the AI business running on cheap, owned power.
It's the ultimate deferred gratification strategy.
It is.
Chapter 3. Financial health. Let's quantify the success they've had so far and the challenges that remain. The market is pricing in this hypergrowth, and the revenue acceleration provides some justification.
The growth is explosive, yes. For fiscal year 2025, IREN reported revenue of $501.0 million. That's a 168% increase year over year. Very impressive.
But that pace accelerated dramatically in Q1 of fiscal year 2026. Revenue hit $240.3 million, which is a 355% increase compared to the first quarter of the previous year. You can really see the ramp accelerating as the early AI infrastructure comes online.
Now, let's look at the profit margin contrast. This is the single biggest financial justification for the pivot. We need to compare the operational margins of the two business segments.
Okay, so the legacy business Bitcoin mining hardware profit margin was 76% in July 2025. That's robust, but pretty standard for the industry.
Right. But the AI cloud services hardware profit margin in July 2025, it was 98%.
98%.
98. That is almost unheard of for any large-scale operational business.
How do they achieve such an extreme margin? Is it entirely the power costs?
It's primarily power costs plus fixed infrastructure costs being amortized over highly valuable compute time. In July, the sources show the AI cloud generated $2.3 million in revenue against a negligible $0.04 million in electricity costs.
So once you buy the GPU.
Once you buy the GPU, which is the major capital expenditure, the marginal cost to run it, given their 3-cent power rate, is almost nothing. That revenue stream, running at 98% gross margin, is pure gold, provided they can secure the chips and keep them running.
But here is the massive counterpoint, the foundation of the bear case, the cash burn. When we look at free cash flow, FCF, the cash left over after all operating expenses and capital expenditures IREN is swimming in the red.
They are massively FCF negative, which is expected for a company in this kind of expansion. In FY 2025, while they had healthy cash from operations, their capital expenditures were $562.3 million. That resulted in an implied free cash flow of negative $316.4 million. They are burning cash to build.
And while the pace improved in the first quarter of FY 2026, FCF was still negative, reporting negative $37.9 million. This confirms they are operating as a major construction project, not a mature cash-generating business yet.
And that cash burn is the single biggest risk factor if capital markets suddenly tighten up.
And the risk associated with that cash burn led to all the confusion surrounding the quality of earnings red flag.
Yes.
IREN proudly reported a headline record net income of $384.6 million for Q1 FY26. To the untrained eye, that looks like a spectacular profit.
But sophisticated investors looked right past the headline.
So why did the stock crash 22% after announcing this record profit?
Because that massive profit was a non-cash accounting gain. It was tied to unrealized gains on financial derivatives, specifically prepaid forwards and capped calls related to their $1.0 billion convertible note.
Okay, that's complex jargon. What does it mean in plain English?
It essentially means they were profiting from the change in the value of their debt and the associated financial hedges, not from operational cash generated by renting GPUs.
So they were reporting a massive paper profit based on financial engineering, while the core business was still burning operational cash to build infrastructure.
Exactly. The non-operational nature of the gain triggered a wave of selling because smart money recognized that the actual underlying FCF picture was still one of deep capital expenditure. The record profit was an accounting fantasy masking the reality of the construction phase.
Okay, but despite that intense cash burn, their balance sheet strength is remarkably good, which is a major point for the bulls. They have a current ratio of 4.29.
A current ratio over 4 is a sign of an extremely healthy short-term liquidity position. They have more than $4 in short-term assets for every dollar in short-term liability.
And this is supported by their huge $1.8 billion cash position as of October 2025.
Yeah, bolstered by the debt offerings. This essentially removes any short-term liquidity risk. They are fully funded for the current phase of aggressive expansion.
And despite that $1 billion note, their leverage remains moderate. The debt-to-equity ratio is 0.48.
That's a healthy number. The convertible note, while large, carries a 0.00% coupon, so the servicing cost is minimal. Management has proven adept at using infrastructure finance techniques to fund growth without crippling the balance sheet with high interest payments. They maintain a solid equity base.
Finally, let's tie all this into the valuation. Their trailing 12-month PE ratio is 171.7. That is pricing in absolute perfection.
It's the ultimate story stock multiple. It forces us to ask, what is the actual intrinsic value? Our educational discounted cash flow, DCF model, attempts to answer this by calculating the present value of all future cash flows expected from the business. The model calculated an intrinsic value of $43.57 per share.
Wait, let me challenge you on that, because this is where the critical engagement comes in. If we are modeling massive growth ramping to $3.4 billion ARR, achieving 98% gross margins, shouldn't the resulting intrinsic value be significantly higher than the current market price of $46.37?
That's an excellent critical question.
I mean, doesn't the fact that the DCF is almost identical to the current price suggest our model is flawed, or that the market is already paying for perfection?
It speaks to the necessary assumptions of the DCF model for a company like IREN. Yes, we had to assume massive growth, the successful ramp to $3.4 billion ARR. However, to account for the immense risks we've been discussing, the execution risk, the Bitcoin volatility, the geopolitical tariff threat, we had to use a very high discount rate.
So the discount rate is the investor's required rate of return, and it acts as a penalty for uncertainty.
Precisely. We used a rate significantly higher than you'd use for a stable utility or a mature tech company. That high discount rate takes those spectacular future cash flows and savagely pulls their value down to reality today.
So the fact that the modeled intrinsic value, $43.57, lands almost exactly where the market is trading, $46.37, means the market is doing the same thing.
Exactly. It acknowledges the spectacular future, but is applying an enormous rational discount due to the immense risk involved.
Okay, that clarifies why the valuation is on a knife's edge. The market is giving them full credit for the opportunity, but heavily penalized for the risk.
It's the only way to justify a 171x PE ratio that results in a price only slightly above the DCF valuation.
Okay, that was intense. Before we move into the second half of this analysis, focusing on market sentiment, ownership, and those terrifying geopolitical risks, we want to remind you of the value of this deep dive.
If this deep dive saved you hours of parsing through SEC filings and analyst reports, please like and subscribe to Stock Analytics AI.
And remember, if you want access to the full breadth of our research, for $4,999 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Chapter 4, Market Sentiment. IREN is a classic battleground stock, meaning the market sentiment is deeply polarized, and that leads to massive daily volatility.
The analyst community technically holds a consensus buy rating, but that really hides a massive divergence in price targets. On the bull side, you've got Roth MKM with a street high target of $82.
Right, essentially believing the execution risk is minimal and the pivot is a guaranteed success.
And you contrast that with H.C. Wainwright & Co., which holds a clear sell rating. They're betting that the cash burn, the capital requirements, and intense competition will cause the stock to massively underperform.
When the spread is that wide, institutions are fighting tooth and nail over the direction.
And the most important quantitative metric supporting the bear case is the short interest. IREN's short interest is currently a massive 21.20% of the float.
21% is extremely high. Anything over 10% signals a major institutional bet against the company. This means that a massive coordinated portion of the market is actively betting that IREN will fail to execute on the Microsoft contract.
Or that they won't manage to acquire the 140,000 GPUs on time and on budget.
Yeah, that's the thing. But if management has this incredible pedigree and they just secured a $9.7 billion contract, why is the short interest so high?
That's the question.
It goes back to the ROIC and the cash burn. The shorts aren't betting the company goes bankrupt because the balance sheet is strong with that $1.8 billion in cash. They are betting that the sheer difficulty of scaling from 23,000 GPUs to 140,000 GPUs in 14 months leads to execution delays.
So those delays would push out the positive returns, making the 1-in-71x PE ratio look ridiculous.
And triggering a sharp correction back towards a lower infrastructure-based multiple.
So the short interest is a bet on timing and execution failure, not necessarily total collapse.
Exactly. However, this also makes the stock extremely volatile. That 21% short position means the stock is a coiled spring.
Right.
If any unexpectedly good news about GPU delivery or successful milestone completion is released, that massive short position would have to cover quickly, leading to an intense short squeeze and massive daily upside moves.
The technical signals really confirm this whiplash effect. The current price of $46.37 is trading below the 50-day moving average, which is up between $52.54 and $58.13. That is a bearish short-term signal.
Right, it reflects the selling pressure after that announcement of the non-cash record profit.
However, the long-term momentum is undeniable. The price remains well above its 200-day moving average, which is way down around $22.01.
This confirms that despite the recent sharp pullback, the underlying power of the AI pivot has established a strong year-long uptrend. The fight is over the next 6 months, not the long-term direction.
Chapter 5. Ownership Structure. Okay, the list of institutional owners provides some crucial context on how the stock is being treated in the market.
It really does. When you look at the top institutional holders, you find a very specific profile. We're talking about firms like Susquehanna International Group, Jane Street Group, Citadel Advisors, JP Morgan, Morgan Stanley, and Goldman Sachs.
So that is not a list dominated by traditional long-only fundamental value funds like T. Rowe Price or Fidelity.
Not at all.
These are the giants of quantitative trading, high-frequency trading, and derivative specialization.
And that's the insight. Their massive ownership confirms that IREN is being traded primarily as a volatility vehicle and a story stock, not a stable infrastructure investment. These firms are experts at monetizing volatility, trading the options chain, and capitalizing on the wide divergence between analyst opinions and short interest.
So their involvement just reinforces the intense non-fundamental price swings the stock experiences daily.
Exactly. But on the positive side, management alignment is extremely strong. Co-founders Daniel and Will Roberts hold significant personal stakes based on their 13G filings.
That gives them substantial skin in the game. Their personal wealth is directly tied to the successful execution of the AI pivot,
which ensures their interests are perfectly aligned with shareholders, mitigating the risk of management making purely self-serving decisions. Overall, the ownership is highly concentrated among insiders and these large, specialized trading institutions.
Chapter 6. Risk Assessment. Let's synthesize the SWOT analysis, strengths, weaknesses, opportunities, and threats to get the comprehensive picture of the risk-reward profile.
Okay, starting with strengths and opportunities. The moat is defensible. 2,910 milligaria of low-cost, 100% renewable power. They have A-list validation via the $9.7 billion Microsoft contract and that NVIDIA preferred partner status.
And the balance sheet is a fortress with $1.8 billion cash to fund the build-out.
And they are tapping into the multi-trillion-dollar GenAI market with a clear path to $3.4 billion ARR and those 98% gross margins.
Okay, now for the weaknesses and threats, which are the basis for the bear case and that high discount rate in our DCF model. Internally, the limitations are pretty glaring.
Yeah.
You've got the massive FCF negative cash burn, the negative ROIC, and the low-quality earnings based on those accounting gains. Externally, the extreme 171x PE valuation leaves zero room for error.
And they face intense competition. And the legacy Bitcoin business remains hostage to crypto price volatility. But all of those risks, they almost pale in comparison to the single biggest hidden threat, one that could derail the entire bull thesis overnight.
The existential geopolitical risk.
Specifically, the GPU tariff time bomb.
This is the risk that sits completely outside of management's control, and it's looming right now. First, remind us about the tariffs on their legacy business.
The legacy business is already squeezed. Steep tariffs ranging from 21.6% to 57.6% are currently imposed on the ASIC miners they import, primarily from China, for Bitcoin. This directly impacts their margins on their core revenue source.
But the real-time bomb relates to the AI pivot. GPUs and related components that are assembled in China are subject to a 25% U.S. tariff.
Right. Originally put in place due to trade war policies.
Section 301 tariffs.
Crucially, this 25% tariff has been waived for most of 2025 to ease supply chain pressures and reduce the cost burden on high-growth sectors. But that waiver is set to expire on November 29, 2025.
So just 2 weeks after our analysis date.
It's 2 weeks.
This is a massive binary threat. Explain the potential financial impact if that waiver is not extended by the U.S. government.
Okay, IREN's entire bull thesis and the success of the Microsoft contract rests on a multi-billion-dollar capital expenditure budget to acquire and deploy those 140,000 GPUs.
No.
If the waiver expires, their entire CapEx budget for those core assets could increase by 25% overnight.
A 25% surge in the cost of their primary asset, the GPUs, would completely upend the financial model.
It would shatter the economics. A company already FCF negative, relying heavily on debt and that $1.8 billion cash position, cannot absorb a massive multi-billion-dollar cost increase without severe consequences.
So that cost surge would jeopardize the entire expansion plan, delay the ramp-up, and violently shatter the 171x PE valuation.
It would likely cause a massive stock drop.
It's just astonishing that the success of a $9.7 billion deal with Microsoft can hinge on a trade policy decision set to happen in 2 weeks.
It illustrates how interconnected global supply chain and political risk are to even the most geographically static infrastructure companies. It is the ultimate unquantifiable risk factor, and it explains why the $43.57 DCF intrinsic value had to incorporate such a high discount rate. You are penalizing the cash flows for this impending binary uncertainty.
Chapter 7. Conclusion. This entire deep dive has been a comprehensive study in market extremes. Let's synthesize these findings and explain what they mean for you, the learner.
The bull case is formidable and rests on a strong foundation. You have a rare defensible moat built on 2,910 milliW of low-cost, 100% renewable power.
And that moat is validated by the game-changing $9.7 billion contract from Microsoft, backed by a fortress-like balance sheet holding $1.8 billion in cash.
And pursuing a path towards spectacular 98% gross margins.
But the bear case is just as compelling, and it's deeply rooted in financial reality and geopolitical fear. A dizzying 171x PE valuation that offers zero margin for safety.
The company is actively FCF negative. Its recent record profit was a non-cash accounting fantasy that triggered a market sell-off, and over 21% of the float is actively shorting the stock.
And the biggest immediate threat is that looming binary 25% GPU tariff risk set to expire on November 29th.
So where does the value truly lie? We return to the comparison point that sums up the market's current mindset. Our DCF model, which balanced the high growth expectations against the terrifying execution and geopolitical risk, calculated an intrinsic value of $43.57 per share.
And the market price on November 14th, 2025 was $46.37.
This is the critical insight we leave you with. The market is pricing IREN almost perfectly rationally. It recognizes the immense upside, the high gross margins, and the Microsoft validation, but it is simultaneously applying a massive discount to those future cash flows because of the colossal execution challenges and the immediate, unquantifiable geopolitical threat posed by the tariff deadline.
So the stock price truly reflects a knife's edge situation, waiting for clear signals on two immediate fronts: flawless logistical execution of the GPU build-out and the U.S. government's decision regarding the tariff waiver.
It's an infrastructure investment that operates like a highly volatile biotech stock. Which brings us to our final provocative thought for you, the learner.
Go on.
If you are tracking IREN for the next 2 weeks, you should temporarily ignore the daily operational reports about Bitcoin hashing or small GPU deliveries. Instead, you must track the news surrounding the GPU tariff extension deadline of November 29th, 2025. That single non-financial geopolitical factor is the most immediate binary driver for this stock's valuation. If it's extended, the bull case strengthens immediately. If it expires, the cost structure implodes.
That is the ultimate focus point. If this deep dive saved you hours of research, please like and subscribe to Stock Analytics AI.
And remember, this analysis was generated by an AI system for educational purposes and should not be considered financial advice. Always conduct your own research or consult with a qualified financial advisor before making any investment decisions.
We'll catch you on the next deep dive.